Hi everyone, I'm going to have a casual chat with you about my thoughts over major events and data releases relating to property which transpired during the month of February. I think firstly we'd probably have to start with the budget speech. That's a very important event every February. And we'd come into February in a rising interest rate cycle. Late January we'd had the second interest rate hike of 25 basis points, and there's been a global inflation problem and many central banks threatening to start hiking interest rates. So we've been going into a rising interest rate cycle already before February. We've had a multi-year rise in government long bond yields, and that's especially important when it relates to property capitalization rates. They've been driving property cap rates up slowly, broadly speaking, over the last few years as government finance has deteriorated. And so we've been looking for something in the property market, I guess, to say that we're possibly moving towards cap rates, some sort of decline, some sort of downward pressure on capitalization rates. That could come from improvements or projected improvements in government finance, or it could come from interest rates not rising anymore and inflation problems starting to sort themselves out. None of this is going in the right direction at the moment, not locally and seemingly not globally either. So we came to the budget speech looking for some meaningful improvements, something that could also make a difference to economic growth. And we haven't really seen much clear sign of that yet. We still see government estimating a 5.7% of GDP deficit for the financial year that's just passing by, and for the next financial year projecting the deficit to go slightly higher to 6% of GDP. So it still projects a rise in the debt to GDP ratio, 69.9% expected for this current financial year ending, and then 72.8% and 74.4% in the next 2 years. Those are better projections than the medium-term budget statements a little while ago, back in October, but still a rising debt to GDP ratio with little margin for error should a parastatal require any unexpected bailout, for instance. So that direction remains the same. Then to look at the components of the budget, well, unfortunately, it's still not clear that government is expecting to make meaningful improvements, in other words, cuts to its current expenditure bill and especially to its oversized wage bill. Still growth in the wage bill expected. Treasury does in the budget review try to make the right noises in terms of seeing capital expenditure grow at a faster pace in the outer medium-term expenditure framework years relative to current expenditure, and that's much needed. But it's probably insufficient to make a meaningful dent, and of course the question is, will such targets be realized given the current expenditure pressures? But they do see CapEx growing at a faster rate, but off a very low base. When CapEx is only 5% of the total budget, you probably need far more rapid growth than a 12.2% nominal growth rate for the per annum for the medium-term expenditure years. So little to signal a strong change in fiscal direction, too little CapEx, debt to GDP ratio still rising for the foreseeable future, and social services eating into the lion's share of the budget. So not being an overly pro-growth budget, I guess from a property sector point of view, that's not a meaningful change from where we are now in a long-term property correction in which real property values have been going down for quite some years. Real meaning that we've had some nominal growth in the last number of years, barring the last two perhaps, where it was all-out decline. But generally property values not keeping up with inflation, and so over a longer period of time actually correcting. And this doesn't give me reason to believe that there will be any change in the next few years. And indeed, if one looks at the Treasury's GDP projections for growth itself, they're very much in line with what FNB expects. An expected, when we get the data, 4.8% for last year, coming off a low base after an over 6% decline in 2020. So that's just a normalization of economic activity after the lockdowns. And then tapering back into mediocre territory, 2.1 expected for this year by Treasury, 1.6 next year and 1.7 the year after. Treasury's projections themselves would therefore suggest to me too that the all property vacancy rate on all commercial property is not likely to turn the corner and go downwards just yet. I think we need a stronger GDP growth rate before that can start happening. So that's my quick view of the budget. I think it's in favor, or it militates in favor of capitalization rates still following their broad rising trend overall. I think industrial property could possibly be the exception there, because industrial properties gearing up for greater logistics and online retail and warehousing space has done particularly well in recent times, so that could buck the trend. But the broader cap rate trend, if you look to offices, if you look to retail, has been going up for a number of years now, and I would expect that broad trend to continue given rising interest rates and giving a budget which doesn't make meaningful changes. There's then the issue that's come about in the last few days of the Ukraine, the Russian invasion of the Ukraine, and what that potentially means. Well, I'm not going to go into too much detail. It's been all over the news. But with in response to the Ukraine invasion, we've seen major Western economies ramping up their sanctions and boycotts. This is economy negative. Positives for the economy are open trade, free trade, no hindrances. What we've seen since the start of COVID-19 is major supply chain disruptions across the world, which have fueled inflation in major economies of the world. So it's not only in South Africa where inflation and interest rates have been rising, it's in places like the United States, where recent inflation rates were as high as 7.5%, which for that country is a very high number. So already these supply chain disruptions of varying types, due to various forms of COVID lockdowns across the world, have been ramping up inflation. Now you add to that the increased boycotts and sanctions and possibly retaliatory measures from the other side across the world, that looks to me like even more supply chain disruptions potentially coming. And there have been fears in recent days of oil supply disruptions for one, and the oil price shot late last week, although it's come back slightly. But this invasion and all the sanctions and boycotts and things that go with it are likely economic growth negative. We have to see how the detail pans out, and likely to be inflation boosting as well. So higher inflation rate across the world, lower global economic growth, rising interest rate cycles, these factors too all point to me towards rising cap rates and pressure on domestic commercial property to property values, or real values at least, in the near term. So nothing really changes my opinion from what's happened in September as to, I've expected this for the correction in property, the multi-year correction, to carry on in real value terms, if not in all-out nominal value. And what's transpiring, the Ukraine just adds a bit of fuel to that, to the fire, so to say. Just looking at some local data releases which came out during the month. Late last year's building statistics completed the picture. Broadly speaking, it looks like, if one looks at building plans passed for, say, residential and residential development, slowing growth, if not slowing or not decline yet, but looks like, if you look at plans passed, that more and more, that during the course of this year we'll have the peak in residential building completions sometime later in the year, and the start of decline. So start of slowing building activity later in the year. That would be in line with rising interest rates. That would also be in line with home buying demand and new mortgage demand, which we saw later last year from the SARB, actually showing slowing growth rates too. Retail, the mainstream retail data growing at over 3% as of December last year, year on year. So all getting back to some sort of normality in terms of main retail components. But when one looks to stuff that's more non-essential and more luxury in nature and got disrupted by the lockdowns quite severely, and I'm talking about hotels, I'm talking about tourism now. Hotel incomes for December came in, and while recovering out of the hard lockdowns where there was almost nothing of it at one stage, hotel incomes are still over 30% down December on December 2 years ago, back in 2019. So the hotel sector, the data is still looking very weak by pre-COVID levels, and nothing much to change my view there that hotels will still this year underperform the big three commercial property sectors, industrial probably being the best off, retail being in the middle somewhere, with a constrained consumer hampering it, but it's out of lockdown now and it bore the brunt of the hard lockdowns. So somewhere in the middle, and the office sector being the underperformer. Now, there's no real data to point to us what the normalization of office attendance is. So I just have to go with my gut feel and what I see around me. But the vaccine rollout has been rolling, so to say. The lockdown, the main lockdown restrictions are something of the past. And so for this year, I've been expecting something of a normalization in the way we work and the way we interact and in economic activity. And for those who are going back to the office, they will be going back to the office this year. I think that's been happening. So what do I see just from going around from various places? I think it's just anecdotal. It's almost as expected, where I see easy parking wherever I go. I see a lot of empty desks wherever I go. There's significantly more people in offices, in head offices in the country, but my perception during the last month or so as office activity normalizes is that, as expected, it's probably not going back to the levels that it was prior to COVID-19. That the Zoomification of this economy, the effective forced work-from-home experiment has been a rousing success. And while we need a certain degree of personal interaction in our daily economic interactions, which drives something of a return to office space, my perception is, early days still, is that it isn't nearly at the levels that what it was prior to COVID-19, where you actually drove into some corporate head office somewhere and you really battled to find a parking space. That doesn't seem to be the case in my experience from now. But that's anecdotal. I don't have data to show what I'd like to see, or at least sort of prove it. That will come over time. But we do know from surveys in places like the US and developed economies that keep coming that there's a lot of kickback in those economies by employees about going back to the office, not so much from employers. They're more keen to have people back at the office, and that it's not doesn't seem to be going back in those countries at least to full employment levels. So that's where the office sector, I still think of the big three. Any evidence that we see over the past month, as I say, cap rates on the rise, broadly speaking, real values still, all the events that have happened militate in favor of further real value correction, and the outperformers and underperformers I still think in the same order as what we've expected. Industrial, retail, office, and the underperformer this year still likely to be the hotel sector. Nothing in the data really in the last month persuades me to change that view. Thank you.